Hey, it's Kristi, and I want to share with you as a mortgage loan officer the 3 top things we're looking at when we are pre-qualifying or pre-approving you for a mortgage loan approval. So very first step is we look at your credit. Not only your credit history, but your overall profile. And what's really important here is your credit scores, but it's more than just your scores, so stick with me here. There is a minimum credit score requirement depending on which loan program we go with. For instance, an FHA loan with a minimal down payment, which is 3.5% of your purchase price, requires a minimum of 580 credit score. And a conventional mortgage requires a minimum of 620 credit score. But it's so much more than just your credit score. We also look at your profile. So it's a snapshot in time, this credit report, and it shows us your ability to borrow money and pay it back on time. How long have your trade lines been established? And are there any collections or late payments? Basically, that decision maker, that underwriter says, if you have the ability to make right on the little things, pay them on time, as due, as required, then that's a good indicator that you'll pay for those big things as well. So that's your credit. The next thing we look at is your debt to income ratio. So this is comprised of looking at your monthly gross income. So that means before any deductions, before your taxes, health insurance, 401 contribution, anything like that, we look at your gross monthly income, and then we divide into that 2 different ratios. We look at your housing ratio, and we also look at your total debt to income ratio. So we really want, in a perfect world, your housing ratio to be about 1/3 of your monthly income. So if you make $3,000 a month, we're going to work at having your housing payment be $1,000 or 33%, about 1/3. So your housing payment is made up of the principal and interest, which is the repayment of the mortgage, 1/12 of property taxes, and 1/12 of homeowners insurance. And if you're putting down less than 3%, or if you're going with like an FHA loan, you're also going to have mortgage insurance. So all of this put together is what we refer to as PITI, principal, interest, taxes, and insurance. So the more you put down, the lower that payment is in relation to that percentage, right? If you put down 20%, it's going to be a smaller monthly payment than if you were to say put down 3%. Okay, so that's your housing ratio. Then the total debt to income ratio is that housing payment plus any other trade lines that show up on your credit report. So what does that look like? Your car payment, your student loans, and if they're in deferment or forbearance, then in most cases we use somewhere between 0.5% and 1% of your outstanding balance as a payment for pre-qualification. Even though it's not due right now, that's what we have to add in as a kind of a fake payment, because at some point in time, those are going to have to be repaid. Then we look at credit card minimum payments or any other outstanding loans or lines of credit that you have. And depending on your loan program, we want that to be somewhere between 45 and 55% of your monthly income, again, before any kind of deductions. So again, we'll add that housing payment, that 33% of your monthly gross income, and then we'll add to that any car payments, credit card payments, student loan payments. This number, this total debt to income ratio, is what trips up a lot of people. A lot of times the housing payment, where we want you to be on paper, is in alignment with where you feel comfortable. But if you have a really high car payment, if you have a lot of student loans, if you have a lot of credit card debt, and unfortunately those households that maintain credit card debt, that carry over those balances month after month, the average household carries over $9,300 of credit card debt. So that could equal hundreds of dollars a month in minimum payments. So all of that smushed together might be a little bit too high for that housing payment that you want. So you might qualify for the housing payment, but be too high on the total debt to income ratio, which means we have to reduce your purchase price to make sure that we stay inside of those guidelines for the total debt to income ratio. So this is in relation to what you're earning currently on your job. So if you recently got a promotion, let's say you were making $45,000 a year, you just got a promotion, now you're making $55,000 a year. We don't average that out over time. We use your current income at the time of your application and processing the loan, except if you are self-employed or if you are using overtime bonus income or commission income as part of your qualifying income, those numbers have to be averaged out over the last 24 months. But if you're just hourly or salary, we're going to base it off of what you're making at the time of application. So if you just got a promotion, it's a great time to apply. And then that last factor is going to be your cash to close. Oftentimes I get a phone call from somebody who says, hey, I have a really great job. I have worked on my credit scores are doing pretty good, but I have no money to my name. That could be a really tough place to be, because even if we're able to access some down payment assistance programs, it may not cover everything. You have to have a little money up front for the escrow deposit. That means cash out of your bank account. That's like kind of your good faith monies when the seller accepts your offer. There are also inspections to pay for. I've seen inspections go anywhere from $395 all the way up to $1,500, depending on what kind of inspections you are doing. So there's a general home inspection, and then there's a lot of other ones that can be added onto it and might actually be necessary. For instance, if you are a veteran and you're applying for a VA loan, we have to have a WDO, a wood destroying organism inspection, and that doesn't have to be paid for by the seller. At least in my state, it's usually paid for by the buyer, which would in this case be you. So if you just don't have any money in savings, that could really affect what your affordability is, because again, that larger that down payment, that maybe the more you can qualify for, because you're not borrowing all of it. You've got some equity or some skin in the game, that money, that down payment, which is the difference between your purchase price and how much you owe. And then also, if you don't have the down payment and closing costs, it may keep you from being able to get approved. For instance, let's say you earn too much to qualify for a down payment assistance program, because in a lot of times there are income thresholds. It's really designed for those people who just earn so little they truly cannot save. It would mean the difference between putting food in their family's mouth or saving for a down payment. So a lot of times there's an income threshold, and it goes somewhere between 80% and 100% of your area's median income. I know for our area, 80% of the median income is like right around the mid-50s for an annual income. But last year's median income for the entire nation was just over $45,000. So it depends on where you fit in. Let's say you exceed that threshold and you don't qualify then for down payment assistance program. In most cases, you have to have at least 3% down payment. And in this current market where it's really competitive to be a buyer, there's not as many listings as there are home buyers. You really can't ask in a lot of cases for sellers to pay your closing costs and have a competitive offer. So it would really be up to you to pay for your own closing costs. That seller has their own closing costs. They pay typically the commissions to the realtors. A lot of times they'll pay a documentary stamp on your purchase. They have their own closing fee with the title company, and so do you. So they have their own closing costs. Their closing costs can often range somewhere between 6 and 8%, where your closing costs will range between 3 and 4%. And that's a percentage of the sales price. So they've got their own costs to worry about, and that means you might have to worry about yours. So in most cases, you need to have about 7% of your purchase price saved up between your down payment and your closing costs. I hope these tips help you. And if you'd like to learn more, if you'd like to really prepare, I wrote a book. It's First Home, Where to Start and How to Win. And it is chocked full with some really great information for first-time home buyers. Everything you'd like to know, everything from acronyms, definitions, the process, the steps, how to be prepared, even money mindset. I have a whole chapter in there about understanding money and money behaviors and what we believe about money, a whole chapter on credit, everything from when you start thinking about a home all the way to what happens after you buy a home. It's in the pages of this book, and I invite you to get your own copy. Thanks for watching. If you have any questions, send me an email, questions@creditkristi.com, and I'm happy to answer them there. Thanks again.